Guys, welcome to lesson one. So I want to talk to you about budgeting. Very important part of the process, right? So what are some important factors that a person should be considering, right, before they go into a pre-approval process?
Right. So as I stated in the opening to this course, there's a difference between what a lender looks at that you can qualify for and what you actually can qualify for. There's things that are in your budget that we don't necessarily see. Most loan programs don't require the lender to determine whether or not you have child care expense. They don't require the lender to determine whether or not you're paying for college tuition for your child or private school tuition or some type of education expense that's outside of student loans. There's things that people have in their budget that don't really show up on a credit report or the type of documentation that a lender seeks. Conversely, there's also things that are in your income stream that you can that you have coming in, but the lender you can't document it on paper to the satisfaction of the lender. So we've talked before in previous segments about debt to income ratios and things of that nature. We talked about the fact that 45, generally speaking, it's not a hard and fast number, but generally speaking, 45% of your income can be allocated towards the payment of your mortgage plus any of your other debt obligations. That is debt, people that you owe. That is not car insurance, utility bills, and things of that nature. It's obligations that you have to pay back on a monthly basis. So you can just add all those up and or multiply your income, your monthly income. We talked about qualifying income, what counts as qualifying income, times 45%, and then subtract out your debts, car note, student loan payments, credit card payments, any installment debts, and what's left is your what you can afford in terms of a mortgage payment on paper for the lender. Like I said though, there's stuff that you know about that we don't know about. If you've got, just because a lender tells you that you can qualify for a $2,000 payment, but you know that after you finish paying all of your expenses and obligations that we don't know about, you don't have $2,000 left over, obviously that means that you don't want to go for $2,000 payment. So it's important that when you do the pre-qualification, you basically ask and let the lender know what is the maximum amount of a monthly payment that you're comfortable with. I'm finding that in most cases, people qualify for here, but the amount that they're comfortable with is lower, and that's great. I love that. When the market, we had the market downturn 10 years ago, we had people whose eyes were bigger than their stomach, than their wallet. People wanted to be able to buy this kind of house, felt like they can afford this kind of a payment, but they, on paper, were only showing that they could be here. So we had to use, or lenders had to use all these crazy loan programs to figure out ways to get them up to the higher amount. So that's not happening these days. I find that most people are very reasonable about what they're looking for. So, start with just doing that basic analysis. You're going to work with your lender to determine how much you can qualify on paper, but then also make a really good budget. We're going to talk about budgeting here in a second. What are your monthly obligations? Look at what you're spending on things like food and entertainment. Those numbers don't show up on your credit report, but it was a real expenses. In some cases, what you're going to have to do is make some sacrifices, right? Because I think we find that when we've got that free money, it just kind of goes, right? We spend more money on eating out and just kind of frivolous things. So, but as part of the process of budgeting, I would highly recommend going back through the last 6 months of bank statements and looking at all of the expenses, all the money that's coming out, how many cash withdrawals you're making, how much you're spending on food, clothing, hair, pharmaceutical, healthcare, and things of that nature. Get all that stuff on paper, categorize it, and then divide it, average it out over 6 months, and understand that that's truly what you're spending. All right. If you can go back a year, you can go back a year. That's what you're truly spending. Now you can make a decision on how much of that can you modify. Are you able to change your behavior on some of these things? All right. So that's in terms of what you really are looking at today. But then secondly, you've got, there are some things that are going to come up with regard to home ownership that you may not have as a renter. You may or may not pay utilities. I mean, most people will still have utility bills, but as a homeowner, you're going to have utility bills. And if the house is bigger than what you're renting, your utility bill is going to be a little bit higher than what you pay in rent. When you're a homeowner, you do have maintenance. You own the house. You can't call the landlord when something breaks. So you do need to set aside or have in your budget an allowance for repairs. Doesn't need to be extensive, probably just a couple $100 a month. If you kind of budget that, generally speaking, that will likely get you enough money throughout the year to be able to handle little things that come up. You're also going to have to, you're going to want to furnish your property, right? You're going to want to, get things, not just big things, but there's like new trash cans, little stuff, pots and pans and dishes and all of that stuff generally that you're going to spend. So think about all those things, kind of put a budget together for it, and then let's make sure that the monthly payment that you are obligating yourself for gives you room to still live.
So you're saying, and we walk right into that budgeting subject because I'm thinking here, understanding that you guys are going to do my pre-approval according to my debt-to-income ratio of 45%, minus my income and then minus my debts, to come up with how much I can afford from a lender's perspective. But I have to keep in mind that there are, like you said, utilities that I have to take care of and other things once, right? Putting a budget, putting some restrictions on myself. I want you to explain a little bit about how impulses can kind of add up in a bank statement, because I understand that a lot of the things that we spend we don't necessarily need, and we don't necessarily want. We just actually saw it, right? But that kind of stuff calculates really, really quickly, and then it's out of sight, out of mind.
Yeah, and that's why I think it's great that beginning the process of trying to prepare for home ownership early, right? So, you start to discipline and change your habits because you are seeking something that's important, that's going to be transformational from a wealth creation standpoint, right? And so you start to pay attention to some of those outflows that you have going, and be more intentional about how you spend your money, because once you step into home ownership, you may not be able to be as carefree with how you spend your money, but that just is a small modification to how we handle our money. But ultimately, it feels like it maybe leads to less freedom, but trust me, and in the long run, it leads to far greater financial freedom than not having some discipline with how you spend your money.
Yeah, no, that makes sense, guys. This is lesson 1, budgeting. Put some restrictions on yourself. Check your impulses and your habits. Understand that we're only using 45% of your income, but we're not accounting for those other payments like utility payments and your wants and all of those kinds of things. So putting a budget for yourself and what you want personally every week, and then maybe eating grocery store, marking all of that stuff out, I think really, really is going to help you out in terms of budgeting. The last question here, how should I be thinking about post-closing? Because yes, I'm trying to be approved, right, to get this home, but life changes. How should I approach this purchase process, but still being able to simultaneously think about where I might be 5 years from now, and what my value in the home that actually helps me make my decision when I'm actually purchasing too.
Well, I mean, I think it's the same thing we just kind of talked about. It's just if you go into the process with a level of discipline about how you're managing your financing, and you budget for things like furnishings, budget for things like maintenance, in the other things that come up in life, car maintenance and things like that. You're making sure that you're continually setting aside, have a savings amount that's creating enough cushion in your budget to be able to handle those things. A good rule of thumb is trying to develop a savings a habit so that you at least get to a point of having 6 months worth of living expenses in the bank. Now, that's hard, all right? And I'm not saying that you need to wait to buy a house until you have 6 months worth of living expenses in the bank, because you're still having to pay for where you live anyway. So why not have it, go to a house that you own where you're creating wealth while you're still trying to build savings,
Right.
as well. But don't look at the home as at the home I'm done. Look at it as now this is just the first step in the journey towards creating lasting wealth and financial security.